Sir, good afternoon. Thank you so much for making time and speaking with us. 65 to 70% of your book is formed of the fluctuating loans, and that's quite visible in the NIM trajectory as well. But with the deposit rates going up, will it continue to get better going forward? Where do you see this number headed when it comes to, let's say, Q3 and beyond?
We had our best quarter ever, and not just in terms of net profit growing 65%, but overall growth was consistent and broad-based, which is very encouraging. In particular, to your question on NIMs, the answer is we had at the beginning of the financial year, or when we did our analyst call at the end of Q4 results, we said this year we expect a NIM improvement between 5 and 10 basis points. And at this juncture, it's beginning to reflect that. It's a composition of both some pricing increase on the credit side, balance and book mix, and the slippages as they tend to moderate down, then the reversal of interest income is lower. So combination of these, and as you know, our liability franchise is very retail in nature, and CASA has been going quite steadily. So I think the NIM expectation for the financial year FY23 is along expected lines. We closed Q1 at about 322. We believe another 5 odd basis points will be the improvement that we can see in the rest of financial year. I'm not getting into particularly on Q3, but I would say between now and year end, we expect the full year average NIM to be somewhere in the 325 or so.
Slippages are slightly higher than estimates, especially on the retail and the banking side. Where do you see any stress if coming in? Is it a concern for now?
No, I don't think I would call out any stress. I said that the retail slippage in the normal period is somewhere in the 100, 125, 130 crores. So about 20-25% worsening on account of the restructured portfolio was and is expected. So where we are at this point in time could be the trend for 1 or 2 quarters on retail. But I think the more important thing is to look at it a portfolio mix and how the overall asset quality is holding. Our slippages as a percentage of assets is close to 1.1%, and that's probably absolute best in class. So, and I don't believe that will worsen. So I would, as we mentioned in our call a couple of days ago, immediately after the results, we think our full year slippages will reflect that 1.1% of the overall assets. And that will continue to be what it has been for 2 preceding years. So on a growing database, the base of customers, base of credit, we are seeing slippage hold well. Within that, within quarters, within the segment, there will be some shift back and forth only because some of the restructured portfolio in certain areas may have a higher stress, and that will sort of play through.
Okay, one important factor in your results this time was that there was no significant impact for Treasury as far as the first quarter is concerned. Are you doing something differently? Because that's not the trend that we are seeing across the board.
No, I think we had said, we called the fact that there would be a rate increase, and we prepared to keep modified duration quite light. And that has been reflected as you see the sort of Treasury losses. The provision for potential losses were almost negligible for us. And that is what we think will be in the coming quarter as well. And these tend to be very yield sensitive. We've managed our book quite well. I have to say that our Treasury team has done a remarkable job, and that we saw the rate increase quite a while back and kept our book light. And that's where it's reflected.
Strong growth in Q1. What are the pockets that you're seeing where growth can coming through? How do you plan to gain more market share?
Yeah, I think for long periods of time, our rate of growth has always been ahead of the industry growth. And during COVID, for very obvious reasons, we cooled off and said better to be mindful of the potential or emerging risk and tone down some credit growth, which we were not comfortable with. As you know, our book is largely secured, and even in a secured portfolio, we didn't want to take any significant risk. As markets open up, as opportunities come back up, particularly we're seeing good pickup in the mid and large corporate credit only because, for a period of time, we've been competing, but not on price. Now, as there's some greater demand from corporates coming back to banks, we're gaining share. And I do think we've we said we will grow between 15 and 18% this financial year. We grew 16% in the first quarter. Annualized Q1 growth was 18%. So I think the numbers that we're guiding for or expecting growth look very achievable, and we are certainly looking to gain share and continue to grow. If it is a CAGR of our growth over the last 5 years, back out the COVID period, it's around 16, 17%. So I think this growth reflects our both capability and the opportunity in the market.
Srinivasan, the street seems to be liking your commentary because the stock is holding up in the green, up around 3.5%. But the other thing that we watched out for in your results this time was that the gold loan book growth has been rather robust, but they have been low yielding. Do you expect this to change going forward and maybe expect it to contribute better in the coming quarters?
No, we continue to be very optimistic about the gold loan growth and the opportunity. So yes, I mean, at one point in time, gold loan was maybe 14, 15% yield product. That's come down to 10, 11%, but it's still higher than some of the other products. And considering that it's a fully secured book with low capital requirements, it tends to be the most attractive part of any large bank's portfolio. And we're happy to grow this quite consistently. This quarter, through the last, say, 12, 18 months, growth was almost modest. Only in the Q4 it started picking up. Q1 was good. And we think this year we should be able to grow 25%, 30% full year on gold, which is a meaningful part of our portfolio. We also like to keep the overall book not weighted toward any one particular segment. So we wouldn't try to get one business dominate everything else. But gold loan at this point in time is close to 20,000 crores. So the business is about 170,000 crores. At the end of FY23, we will see gold at about close to 30,000 crores. These numbers are to just give you dimension.
You have also been tying up and partnering in with some of the fintechs to, for doing some loan business, for example, Jupiter, FI Talk, to also about traction over there. Can you just give us about the contribution of growth coming in from those new age businesses?
It's a good question. Firstly, I just want to call out saying that our approach to fintechs, not just now, for maybe the last 18 months, we've been working very closely with very good fintechs who become our partners. We have created a technology capability that allows them to work with us quite seamlessly. And a large number of our fintech partnerships are in the area of new client origination and largely in the deposits and liability space. On the credit side, there's only two significant ones that we're working on. One is for gold loan called Rupeek, and the other is FPL for credit cards. And both of these are doing well, but must remind that these don't add up yet in materially large part of the volume, considering the overall book is about 150,000 crores. On the margin, these are meaningful, and we think this has potential to scale up and grow. On the liability side, it is at this juncture too early to tell because we're building a lot of customers who are new to category, new to us, but they take time to build balances. So we see this relationship as they bring the front end, ease of acquiring customers, very attractive propositions. We have a solid platform, and that's how the distribution and platform relationship is working. We have said that it will take time for it to mature and start turning to be very value accretive. At this point in time, it is a distribution arm getting us good client base, and each has its own sort of financial and dynamics which will work through over the coming quarters.
Okay, Mr. Srinivasan, we let you go on that note. Thank you so much for making time and speaking with us today. That's the